So welcome back to My 5XYZ, where we're going to talk about part 2 of cybersecurity. So if you missed out on part 1, part 1's on Wednesday, and it is talking about kind of what data is, where our data is being created, how is it going to be protected through cybersecurity, and what the different components within cybersecurity are. We also covered cyber or CIBR, which is an ETF that covers cybersecurity. Today we're going to talk about 4 individual companies. The first one is going to be called PaloAltoNetworks. PaloAltoNetworks is a global security leader, and it is shaping the cloud-centric future with technology. It is transforming the way people and organizations operate. So what they try to do is help address the world's kind of greatest security challenges with continuous innovation that seizes the latest breakthroughs in artificial intelligence, analytics, automation, and orchestration. This was pulled simply from their website. So they say that by delivering an integrated platform and empowering a growing ecosystem of partners, we are at the forefront of protecting tens of thousands of organizations across clouds, networks, and mobile devices. The way they aim to do this is through a couple of different solutions that they provide. The first being firewall as a service or firewall as a platform. And the second one is SASE, or Services Access Service Edge. And for them, their product is called Prisma SASE. The third is going to be Cloud Native Security Platforms, or CNSP, and theirs is called Prisma Cloud. And then finally, Security Automation, their product is called Cortex. So those are the 4 main ways that they're offering kind of cybersecurity, and that's how they generate revenue as a business. For PaloAltoNetworks, I looked at their financials, and so for Q1, the first quarter of fiscal year 2022, they showed a total revenue of $1.25 billion with year-over-year growth of 32%. These numbers are going to be a little bit long. You can find them in the description. You can go check out their investor relations websites and find out their actual financials for yourself. But if you want to listen along, we're going to continue to cover a lot of information. So operating revenue is $224 million, which is up 9% year over year. Their earnings per share is $1.64, which was 7 cents over their Q1 guidance. So by and large, it's showing that they are meeting expectations, even beating it a little bit. So that's going to be the first thing you're looking for whether or not you should invest in a company is, are they growing? Are they at the very least meeting expectations of what analysts are forecasting? The next, product revenue growth for Q4 2021, which was the previous quarter than the one we're talking about, as well as Q1 2022, which was this quarter, was 25% for this most recent, 11% for the previous. This is notable because for them previously, the previous 3 quarters actually showed basically only about a 3% product revenue growth. They call this the inflection point. And so this goes to show that maybe we're seeing a more rapid adoption of cybersecurity as a necessity in growing our kind of data. We want our data to grow. We want it to process and compute quickly, but we also need it done securely. The two need to be synonymous. They can't just be one without the other. So based off of their individual products, we're going to kind of talk about them in each component. The first is going to be Strata, or their firewall. For this, they showed a billings growth of 29% in Q1 2022, which was 20% higher for the last 4 quarters. Prisma SASE showed a Q1 22 of 100% year-over-year annual recurring revenue growth. Prisma Cloud showed total customers of 1,723, up 30% year-over-year. Their Cortex security automation, their customers grew to 2,859, and that was up from 1,585 from the same quarter a year prior. And so going back actually to Strata, it was 29% in Q1 2022 and greater than 20% in terms of billing growth for the previous 4 quarters. So minor edit to that. For PaloAltoNetworks, they had some other things that they wanted to make sure on their little slide deck that were kind of noted. And so some of these were that there were 160 7-figure deals in Q1 2022. That seems like a lot of money and a lot of people that are kind of putting their money and investing in them for their cybersecurity solutions. I don't know what this is in comparison to everything else. And so in a vacuum, while this looks good, if company B is doing way more, then suddenly this number doesn't seem all that impressive. And so that's what's important. When you're looking for an individual company within cybersecurity or any other kind of sector, you want to look not only on that company, but what its competitors are doing and see how the two stack up together. Maybe even look into the market share. So they had 36% year-over-year growth in total dollar value of 7-figure deals in Q1 2022. And yep, that is just for that quarter. They had an 8-figure deal with a Fortune 100 utility for new SASE architecture, an 8-figure deal with U.S. federal government agency for Strata, Prisma, and Cortex solutions. So if I'm going to be investing in a company, it does help to know that they're getting steady, reliable income from the government, especially with the recent infrastructure bill. And then they have a 7-figure deal with European Bank for Prisma Access, Cloud SWG proxy replacement, and Cortex products for over 40,000 users. So if a bank is wanting to use them, especially one with that size, that is also reassuring that maybe this company has its stuff together. Kind of moving on to the next company, it's going to be Accenture. In the previous video, you kind of listened to me talk about some of their kind of forecasting what the state of cybersecurity is. And so this is the company that provided that information. And so let's look at their financials. So before we get into that, we need to know a little bit more about Accenture. And what they say is they're part business consultancy, part creative agency, and then part technology powerhouse. So they're organized to have strategy and consulting, and they want to do technology and operations. By and large, what this means is they want to be a one-stop shop so that they can consult and evaluate your needs, go ahead, come up with a custom solution, and then provide it for you. Or at least that's what my understanding was of what Accenture is actually doing. When I talked to my dad, he billed them as more of just a consulting service, but the more I kind of dug in, it looks like they've made some acquire for security and actually have some security products. But I could be wrong again. I don't know a lot about cybersecurity, not an expert on this. But some of their technology capabilities, they said, are on cloud, infrastructure and software engineering, data, platform services, technology innovation, security, automation, application management. By and large, it sounds like a whole lot of buzzwords with not a lot of content. So again, their website was very kind of hard to see how they're actually delivering on that cybersecurity aspect. With PaloAltoNetworks, it's a little bit more clear. So for their cybersecurity, it says combining managed security services, market-leading advanced analytics, intelligent automation, cyber defense incubation centers to kind of help out innovate our kind of attackers on an every single day basis. Going to their financials, they have Q4 fiscal year 2021, and the performance earning report showed this. Their total revenue was $13.4 billion. This was an increase in 21% in their local currency, or 24% by US dollars. In North America, they had 22% growth and $6.4 billion. For Europe, it was 18% growth and $4.3 billion. And for growth markets, 21% at $2.7 billion. Within their sectors, the breakdown of how they make money is based off of kind of communications, media, and tech, 23% or $2.8 billion. Financial services, 20% or $2.6 billion. Health and public services, 18% or $2.5 billion. Number 4 is products, 25% and $3.7 billion. And then finally, resources, 13% and $1.8 billion. So they have multiple kind of different avenues how they're making revenue. It seems to be a diverse business model. But going more into kind of the financials again, their earnings per share was $2.20, a 29% increase. Their operating margin was 14.6%, an increase of over the last time that they measured it. Their new bookings was about $15 billion, a 7% increase. And again, this is for that quarter. Okay, we'll get to their whole fiscal year with the next slide. But the return to cash to shareholders. So that's always something important to me as an investor. I want to see how the company is not only profitable, but how they're returning that value to me. And they can do it one of two ways. They can do it through dividends, where everyone that owns a share gets a cut of that profit or money made, or through stock repurchase or buybacks. What they do is they buy back stocks from shareholders, so that specific shareholder gets the money out of it. But this tends to drive up the price, so everyone else also stands to benefit. So shares repurchased were 915 million, and dividends paid was 558 million. Their quarterly dividend was in September of 2021, 97 cents per share, which was a 9-cent increase, or about 10%. For fiscal year 2021, they had a full report since they just finished out the Q4, and it showed total revenues $50.5 billion, an increase of 11% in local currency, or 14% in US dollars. For North America, this was a 12% increase at $23.7 billion. For Europe, 8% at $16.7 billion. For growth markets, 11% at $10.1 billion. For their operating margin, it remained around 15%. Operating margin is really important. It doesn't matter if a company is making tons and tons of money if their operational expenses are pretty much in line, taking up most of that money. If all the revenue you're making is going to operating expenses, that means your net profit is going to be very small. So having an operating margin of 15% is good. But again, everything is based off of context. You want to see how other cybersecurity kind of companies' operating margins are. If the operating margin at 15% is much lower than other ones, that tells you you have a business that is very smart with their money, operationally efficient, and is a company that I would feel maybe a little bit more inclined to invest in. For free cash flow, $8.4 billion. So having cash available to invest, to do mergers and acquisitions, to kind of expand their business or drill down on certain aspects of their business that they want to improve. That's important. You need a company that's not just struggling to survive, but one that is throwing off money that they can then invest or save for a rainy day if unexpected things happen, like we saw with 2020, COVID. Things shut down, business plans had to be kind of reimagined. And so having cash on hand is always important. It's no different for the individual investor. Cash returned to shareholders. This was huge for me, $5.9 billion. That's just a lot of money for me to conceptually understand, but they had about $2.24 billion given back in dividends, and share repurchase was $3.7 billion. So for Accenture, their GAAP EPS was $9.16 for 2021, 16% increase. Their operating margin was, again, 15% for that year. Their new bookings was $59.3 billion, a 20% increase. So they're getting more revenue, they're signing more clients. They have a strong free cash flow of $8.4 billion, and they return cash to shareholders, $5.9 billion. Shares repurchased, 3.7. Dividends repaid, like I said, 2.24. That's a lot of money given back. So we've covered two. The third one is going to be Cisco. And on their website, they say that their mission is to shape the future of the internet by inspiring new possibilities for them by helping transform their infrastructure, expand applications and analytics, address their security needs, and empower their teams. To execute on strategy and address our customers' priorities, we are focusing on the following 6 strategic pillars. So for Cisco, they're looking to secure agile networks, hybrid work, optimize application experiences, end-to-end security, internet for the future, and then finally capabilities at the edge. So Cisco is actually one that I came into contact when I was researching 5G. They're one of the 9 providers for 5G, and so I was excited to see that there was maybe some redundancy, and it was an opportunity to learn more about a company that I didn't get a chance to learn about for the 5G kind of episode. If you haven't heard about that one, just go back and look. So for Cisco, the solutions that they offer are network collaborations, security and cloud, and computing. So they want to focus on driving higher subscription revenue, as this provides a recurring stream of revenue. You're going to hear about ARR, annual recurring revenue. And so that's just something that companies are moving towards. We have things like software as a subscription. Instead of selling out software and having these one-time costs, you can actually just have renewable billables through subscription services. So what they have is Cisco Plus Solutions. It's an initial network as a service offering, which delivers hybrid cloud technologies and will later expand to a broader catalog of services built and delivered with our partner ecosystem. And so you basically can, as a subscription, get your network for your company. For the next thing that they have in terms of generating revenue, it's the Webex Suite or meetings. It offers secure, integrated audio, video, and content sharing from any device, anywhere. So this is essentially their equivalent of Microsoft Teams or maybe Zoom. So I don't know exactly the whole backstory, but I think part of the backstory is that actually Webex was sold off by the creators of Zoom and was never just fully developed. Once the obligations ran out, they ended up bringing out Zoom, and it was positioned in the right time at the right place for when COVID happened for their stock price for Zoom to go nuts. But anyways, I digress. Not 100% sure about that. I'm going to maybe do a little bit more digging on that, maybe leave a kind of link in the description, but I digress. Third one is going to be SecureX. This is the one that we're actually paying attention to as we are talking about cybersecurity with this video. For SecureX, as the largest enterprise cybersecurity company in the world, we lead the way with solutions that are driving the industry in SaaS, or SASE, XDR, and Zero Trust. So these are some of the other buzzwords that you might have heard in the previous video, but it seems that Cisco Systems is actually pretty big within cybersecurity. That was something I was unaware of. Their forward focus areas will include hybrid cloud, hybrid work, 5G, Wi-Fi 6, edge, security, and cloud native architectures. So this is a company that's got a lot going on. It's trying to build out network services. It's trying to build out security services. and then potentially ways to reimagine how work happens, not just at work, but potentially a hybrid or remote work. So for me, I think stagnant is a big word that came to mind when I was reviewing their financials, but the hope is maybe that COVID created a new kind of opportunity for them to kind of rebrand, become more efficient, change their business model so that they can hopefully be more successful emerging from kind of 2020, 2021 with the pandemic. With our shift towards potentially hybrid work, they might be better positioned to be a more successful company as these revenues align with what they're trying to deliver. So revenue trend, 2019, 51.9 billion, okay? 2020, 49.3 billion. 2021, 49.8 billion. That's what I mean by stagnant. The revenue is consistently staying the same. So it's not going up, not going down. And so that means that they are maybe mature and stable, but are they going to grow? Are they just going to slowly kind of fade into obscurity? That's one thing that's going to be important when you're investing in something as essentially like a legacy like Cisco Systems. Their operating cash flow for 2019 was 15 billion, for 2021, 15.4 billion. For 2020 was 15.4 billion, 2021 was 15.5 billion. For their margins, the gross margin was 62.9% for 2019. For 2020, the gross margin was 64.5%, and for 2021, the gross margin was 64%. If we're looking at operating margins for 2019, 27.4%. For 2020, the operating margin was 27.6%, and for 2021, the operating margin was 25.8%. Again, Cisco Systems seems to be a company that is maybe reliable or stagnant, your choice. For them, their primary use in cash in fiscal year 2021, the way they broke it down was repayment of debt was 15%, share repurchase was 15%, capital expenditures was 3%, dividends was 31%, and net acquisitions was 36%. So that net acquisitions actually makes me excited. It means that they're trying to innovate, they're trying to grow, they're trying to expand potentially their business model, hopefully to kind of break out of the stagnation that I see and hopefully make them more effective, more efficient to grow and return value to its shareholders. So the remaining questions is, how will Cisco emerge from the pandemic? And will this restructuring lead to increased growth in revenue? And how will the operating margins be affected? And what I mean by this is operating margins are going to be affected by all companies as we kind of navigate these supply chain issues that have been kind of brought to bear with this whole pandemic. For Q1 2022, it was released on November 17th, 2021. The benefit of now is kind of that we get to see what 2022 looks like compared to 2021. So for Q1 2022, what their revenue was 12.9 billion. So it was up 8%. Their net income was 3 billion, and Q1 for the fiscal 2022 was up from 3 billion compared to 2.2 billion for the same quarter in the fiscal year 2021. And so that's a 37% growth. So that is exciting. So like I showed you for the previous kind of years, 2019, 2020, 2021, it was maybe stagnating for fiscal year, but for the first quarter for 2022, it's actually looking good. Cost of sales was up 11.5% and operating expense was down 7.9%. So that was the other thing that I was kind of forecasting. If they're going to be breaking out of stagnation, it's also important that they are becoming operationally efficient. So is it going to be more expensive to deliver on the revenue that they're generating? And are they going to be able to keep their operating expenses down? So their GAAP earnings per share was 70 cents, which was up 37%. Their Q2 guidance showed a revenue of 4.5 to 6.5% growth year over year, with an EPS for the GAAP of 64 cents to 68 cents and a non-GAAP of 80 cents to 82 cents per share. For fiscal year 2022, they're showing revenue of 5 to 7% growth year over year, and a total earned EPS for the GAAP $2.77 to $2.89, and the non-GAAP was $3.38 to $3.45. So it is interesting to see what they're going to do. We'll see how they play out for their fiscal year 2022, but it is one that I have my eye on. And then finally, we're going to get to the fourth one, which is CrowdStrike. And so CrowdStrike was founded in 2011, and it is trying to reinvent security within the cloud era. Like I had mentioned, cloud and how we store our information has changed how we need to protect it and all the different kind of variables that get introduced. So they have what's called the Falcon platform. And on their website, they said that they created the first multi-tenant, cloud-native, intelligent security solution capable of protecting workloads across on-premise, virtualized, and cloud-based environments running on a variety of endpoints such as laptops, devices, servers, virtual machines, and Internet of Things or IoT devices. They have 21 cloud modules within their Falcon platform, and this is a SaaS or SaaS, service as a subscription model. Again, this word is kind of coming up pretty frequent, whether it's from when I was listening to Autodesk investors to all the stuff here. This is kind of a go-to word now, SaaS. And so you should probably read a little bit more about it and see how this might kind of apply to some of the other companies that you're investing in. But I digress. They say that it spans multiple large security markets, including corporate endpoint security, cloud security, managed security services, security and IT operations, threat intelligence, identity protection, and log management. So for them, looking at their financials, they had $1.34 billion. And this was an annual recurring revenue, which showed a 70% growth in their ARR, or annual recurring revenue, for year-over-year growth. It had 94% subscription revenue with 71% subscription year-over-year growth. They had 13,080 subscription customers, with 66% of them having 4 modules or more. They have 64 of the 100 Fortune 100 companies, 234 of the Fortune 500 companies, and 14 of the 20 top banks, whatever the top banks are. So for them, they have a total addressable market that they forecast of $36.5 billion in 2021, with a 2-year combined annual growth rate of 9%, with the total addressable market for $43.6 billion in 2023. And so there seems to be a lot of market available, and that's why I think cybersecurity is an interesting area to grow in, because as we push towards the metaverse, as we push towards autonomous driving, as companies go more to remote or hybrid, there's going to be huge amounts of data generating, and how we protect it is ultimately going to be very important. So for CrowdStrike, these are the ones where I ended up finding that information, or the tidbit from the International Data Corporation, where I said that our cloud workload is underprotected, with 2021 and 2020 showing that maybe we invested maybe about 1% rather than the 5 to 10%, which would be the expected standard. So total revenue for them for Q2 fiscal year 2022, there's some rounding, but $337.7 million. Their total cost of revenue was $90.4 million. Their total operating expense was $294.7 million. So what that actually means is they had a net loss of $57 million. That's a lot of money. And so that's what I meant, and I kind of alluded to this when I was talking about PaloAltoNetworks. It seems like potentially they had similar net revenue, but when you go to their net income, I think PaloAltoNetworks had positive, whereas as you see here for CrowdStrike, they have a net loss. And so that gets me kind of confused, or kind of wondering, why should I invest my money here versus PaloAltoNetworks? Is this one potentially going to have more growth potential and maybe higher growth in terms of stock price appreciation? But what is the risk that I'm exposing myself by picking this one over the other? And so that's something I don't have a good answer for you. Like I said, this is me just doing my homework, trying to figure out how to get better at investing. And so you're watching me grow as kind of I'm trying to help share what I learn as I go. And so other companies that I was interested in but didn't get to cover is going to be IronNet. IronNet, what I was kind of digging around just briefly, they have a partnership with Microsoft Intelligent Security Association, Collective Defense Community for Space, and a strategic partnership with Mandiant, which is a part of FireEye, which is a privately traded cybersecurity company. Sentinel One had their IPO on June 30th, 2021. And then OKTA, they're a leading independent identity provider via the OKTA Identity Cloud. That was the 5th one in this cyber. I just didn't get a chance to kind of delve into it. But that's essentially the 4 companies that I'm looking at based off of starting off with Cyber ETF. So the conclusion for this is simply, we have these 4 companies. There are plenty of other companies within cybersecurity, and you need to do your own due diligence. You need to figure out what your risk you're willing to accept, whether or not you're going to be wanting to invest in maybe more stable, traditional companies that you kind of know what you're going to get, but you're not going to have huge growth, or you're going to invest in some of these smaller companies that might be high flying 5-10 years from now. I don't know what any of these companies are going to do in the future. No one does, and you're just making calculated bets. These calculated bets will have a higher chance, hopefully, of hitting or appreciating your money the longer out that timeline is. I think that's more the case for these stable ones, but when you have these smaller companies, you might have a higher upside, but again, there is a possibility companies will go bankrupt. And so you have to just be very careful, very prudent with what you're investing your money in, and make sure you do your proper due diligence, because if you have convictions in that company, it makes it a lot easier to hold it through the bumpy parts. But that's my take. If you like what I have to do, go ahead, like, subscribe, set an alert so that you know what the next one is. Not sure what the next topic is going to be, but I'm thinking between 3D printing or AI. But appreciate you listening. Thanks.